Good afternoon, everyone. This is Henry, and as we get into this afternoon's discussion, I wanted to bring you kind of a basic way of thinking here in Tesla. So I like using moving averages on the daily chart in this type of a combination. That is to say that I use the 5 and the 10 to create a way of looking at the most immediate, the most aggressive trends. They're usually going to follow the moat, the zone that is created between those two levels. And then if you do not hold the zone that is the 5 and the 10, well, then the reversion to the mean at the 21 EMA is more likely what you may be going through. So if we look at that way of thinking here in Tesla, you can see where it recovers the moving averages all kind of right through here. And then the pullback that we saw on Wednesday was right to go bid at that 10 EMA. So the 10 EMA can be a good one, again, for following this kind of short-term but still swing-based momentum. And then if I see that it's going bid at that level, well, then I want to try to play in the direction that that moving average is going, which is generally from lower left to upper right. So one way that I'm looking at doing this is to say that, because it's kind of a fine line, like maybe it gets 200, maybe it gets 204, but of course the timing is always the question. So I'm going to show you a spot where you can do a couple of spread strategies, essentially taking in a credit down here and using that credit to finance a debit on the upper end. If Tesla just has the bottom fall out of it, there's a lot of risk in this spread. But, you can always manage if it does start to break down, and this is what it would look like. So this is a spread that is priced out as of Thursday's close, and one of the things I'll be looking at on Friday. But what you're trying to do is initiate the unbalanced butterfly down here with the puts. And as long as this trade can go for a credit, it's the idea that if you can do two of them, well, two of those at 15 cents will generate a 30-cent credit. Then you can take that credit and come over and apply it to the debit that has Tesla moving into higher prices. Now again, what you can see from your risk profile is that if Tesla goes to zero, risk is capped, right? There is a spot where the pain will stop, but there is $1,000 of risk in this trade. But the thing I want you to see, again, first recognizing risk, always. But then from there, look at the money you make at 200. Look at the money that you make at 170. Again, say I'm wrong, and it moves to the lower end of the range. You can actually still get paid down there on that end, and if you're anywhere in between, it's just a scratch, because this pays for this. And I really think that's a great way of thinking about structuring your spreads, giving yourself more than one way to make money. And when you find yourself against those key strikes like 200, I believe those butterflies are worth considering. So I hope you find it helpful. You guys have a great Friday, and I hope to see you in the next free video. Hey traders, this is Henry with simplertrading.com. I wanted to thank you for watching today's video. I hope you found it helpful. And if so, be sure to click the like and subscribe buttons down below. If you would like to also see me putting these ideas into action and trading my own account live in front of you, be sure to sign up at simplertrading.com, and I hope to see you in the chat room sometime soon.